Today, I'm going to be talking about how required minimum distributions work, or most commonly referred to as RMDs. Today, we're going to talk about why you have to take them, when you have to take them, how much you have to take out, what types of accounts you have to take them from, and most importantly, how to avoid costly penalties. Because if you do this wrong, you can face pretty hefty fines. So make sure you stay tuned to the end to discover how to avoid those fines. So Derek Mazzarella with Gateway Financial Partners. Let's get into it. So what's the why? Now, this is, pretty straightforward. Basically, these are accounts that have never been taxed before. So think traditional IRAs, traditional 401ks. You get the pre-tax deduction today, and the money goes tax deferred. Now the IRS is saying, hey, look, we haven't gotten any taxes on this money at all. We need the taxes at some point, right? So we're going to require you to take money out of these accounts so we can get tax revenue. So that's one. The real question is, okay, when do I have to take them? So it depends on when you were born. So up until 2022, in 2022, basically, if you were 72 years old, you had to take money out in 2022. But beyond that, if you were born in 1951 to 1959, your RMD age is going to be 73. If you're born in 1960 or after, your RMD age is going to be 75. So you're not required to take any money out of those IRAs or 401ks until you hit this age. The timeline matters because year one is a little unique when it comes to your RMD age, and let's get into that a little bit. And here's how they look at it. So they're going to say, okay, in year one, this is the calendar year you turn 73 or 75. So let's say your birthday is here in May. So you can have to take money out at any point during this calendar year. The exception is for your first year of RMDs, you can actually put this off until April 1st of the following year. So you can actually forego this whole year and then say, okay, I'm going to take my RMD right here at this point. Now, as you may notice, in year two, in the second year, the same thing happens. So you have January 1 to December. You may, and you wait till, let's say, April again, you're taking an RMD here, and then you're maybe taking another RMD at this point. So you're actually taking two RMDs in the same year, which may or may not be beneficial. Depends on a lot of factors. It depends on how much income you had, in this year compared to what you're going to have the following year. So there's a lot of things you really want to make sure you're looking at. Definitely review it with your accountant or CPA to figure out what makes the most sense for you. But just know that in year one, you can push it off up until April of the following year. Other than that, each year after that, you have to do it within that calendar year. Okay, so the real question is, all right, how much? Now, this is really determined on two factors. So the first one is, what was your account balance as of 12/31 of the previous year, right? So if they look at all your qualified money, so anything that hasn't been taxed yet, and say, okay, my account balance is 100,000, they're going to calculate your RMD based on that account value. And the second piece of it is going to be your age. So they use a mortality table, basically, that's going to calculate your RMD by the mortality or longevity factor, however you want to phrase that. The easiest way to do it is look up a RMD calculator online, put in the account value, put in your date of birth in there, and it'll give you how much you should take out as a required minimum distribution. Now, you can always take out more than that, but you don't have to. You have to take out at least that amount. And the one kind of funky thing you want to look at is, a common question is, well, do I have to take it out of all the accounts? Let's say you have 2 or 3 accounts. Let's say you have a traditional IRA and you have a 401k. It kind of depends. So if you have only your money in IRAs, you can say, okay, my total combined amount is 500,000 between 4 accounts. You could take the whole RMD from one account. You could take it from all 4 of them, but if you want to take it from 1 or 2 of them, you can do that. But if you have an IRA and let's say a 401k still, you have to take it out of the IRA and you have to take it out of the 401k. So you would have to take it out of those 2 accounts separately. So it could be a reason to roll money from a 401k to an IRA, but just know that that is a requirement. They treat 401ks separately. So if you have 12 401ks, you're taking out of 12 different accounts. So just make sure you're clear on that and how you're taking the money out. So the last thing is, what happens if I don't take money out? So they actually reduced this penalty. The penalty used to be 50% of the amount that you didn't take out. So if you're supposed to take out 10 grand, you were charged $5,000 as a penalty. Now the penalty is 25%, so it's gotten much better or much easier for you if you don't take the required distribution out. However, if you recognize quickly, it's like, oh shoot, it's just January and I need to take the RMD out, I'm going to correct this on my own, the penalty may be dropped down to 10%. So don't put it off if you make a mistake. Take care of it right away and try and correct it as soon as possible, because it's a 15% difference in the penalty. So if you catch it versus the IRS, that's a pretty significant difference. So basically we looked at today why you do RMDs, when you should do them, how much you have to do, and what are the penalties. So any questions, please feel free to ask me, and check out a few other videos I'm going to have coming up talking about how do we actually get around this from a tax standpoint, or what are some strategies we can do to help reduce your RMD requirements moving forward in retirement. Derek Mazzarello, Gateway Financial Partners. Talk to you soon.